Alright guys, so let's do a mission update, global update to close off the week. We once again have major regret in the West over the Russian oil hits. It's 2022 and 2023 all over again, but this time the stakes are even bigger. Then we had Trump sign yet another desperate deal. It's so funny that you realize probably none of it will come to pass. Countries are just running circles around his tariff war. Finally, the affordability crisis just got worse. It's so nasty that overall consumption is starting to plunge. This AI spending craze is going to slam into a wall of frustrated Americans. But let's start with Western regret. Now, by now, we know the state of their hits on Russian oil. Sanctions have been imposed while Ukraine has been striking Russian energy infrastructure. Well, it's war, so we should expect things to get nasty. But there are big blowback effects that you can't escape: cause and effect. Western consumers are now feeling the pain at the pump. Now, are there winners? Sure. Big oil companies and refiners, they are winning. Refining margins are sky high, but for consumers, the worst is yet to come. But seriously, what do you expect? By striking Russia's energy system, you have now taken away millions of barrels of diesel and gasoline from the world, and that directly feeds into CPI inflation. Now, in the US itself, gasoline and diesel prices are back to the levels before Trump even took office. This is not good for an administration that needs oil prices to come down. Tariffs alone are painful enough. However, the situation could escalate. US sanctions on Lukoil and Rosneft, they are coming. The EU is also about to lob new sanctions on refined products made from Russian crude. So now the Western world will be facing a shortage of Russian barrels on the crude side. Russia is a huge exporter of gasoline and diesel as well, and it's going to be compromised even further. We can see Russian refining volumes have indeed dropped. Compared to the last year or the last 5-year average, we are down by 10%. Russia's only processing 5 million barrels per day of oil. Now, this isn't good because the West will face a double squeeze. Russian barrels are already dropping, while Lukoil and Rosneft sanctions will cut away any remaining barrels. On the surface, this does put some squeeze on Russian revenues. If Russian exports less, then obviously some earnings will be hammered. But is it really enough to cripple Putin's economy? We are headed back to another battle of energy attrition that will ironically make BRICS stronger versus the West. Now, according to the IEA, Russia's revenues fell by around 20% in October. It is down to $13.1 billion. Exports fell by 150,000 barrels. US sanctions are going to put more pressure on it, but it will largely hammer the G7, who has to obey orders. The big boys in BRICS are going to benefit big from the sanctions. Now, Russia has learned a lot from the Biden sanctions regime. They have fleshed out their entire shadow fleet. And can the US really enforce their punishments on the buyers as well? That is the big question. Now, as we mentioned before, the Russians have begun their game of whack-a-mole with the US. They are creating new shell companies and entities to sell their oil to the world. The IEA themselves admitted last month alone, 3 new firms exported 1 million barrels a day of Russian crude oil and products. The companies began operating only in May, and they are not on any sanctions list. We can expect Russia to unleash a tsunami of shell companies to bypass Trump's oil sanctions. The only way to enforce a global embargo is an even lower price cap or directly punishing countries that buy Russian oil. But it risks spiking up inflation again. Now, Trump is beginning to exempt tariffs on bananas and coffee. The administration has their hands tied, and we are beginning to see them crack.
Substantial announcements over the next couple of days in terms of things we don't grow here in the United States. Coffee being one of them, bananas, other fruits, things like that. So that will bring the prices down very quickly. And Brian, we inherited this affordability mess. It was the worst inflation 40, 50 years, one of the worst in the nation's history.
Guys, this is a crazy admission from Besson. So consumers do feel the pain from the tariffs. That tariffs do raise prices substantially, as if we all didn't know how they already work. Tariffs cause inflation to US consumers. They are putting out the fire they created in the first place, which is extremely bizarre. And if we extrapolate this, the US can't possibly enforce the Russian oil sanctions on global buyers. It will only reduce barrels to the world and spike energy prices even higher. Now, the big winners from this will be China and India. India, if they continue buying Russian barrels. Now, Beijing is not going to stop. In fact, their imports have gone ballistic in October. In crude oil alone, China bought nearly 4 billion euros worth from Russia. You throw in LNG, coal, and pipeline gas, it's almost 6 billion euros. Once the US sanctions fully hit, we can expect excess oil to flow towards China. Higher supply will push down prices for the Chinese. They are the most convenient outlet for Putin to sell to, and this makes Chinese inputs and power generation, especially power generation, that much cheaper. Now, what is the biggest fight between the US and China today? Well, let's guess. It's AI. What is needed to fuel the AI race? It's not just chips, it's not just semiconductors. Massive amounts of energy and power generation is needed. Now, Bank of America wrote a simple note: no power, no AI. It's simple and it's all that we need to know. It's why Chinese infrastructure stocks have rallied by an incredible amount. Some power and solar companies are up by 100% or more in under 12 months. Everyone knows the struggle comes down to energy. The Russian sanctions will only empower Chinese energy generation. Now, this is not a win for the West. The second order effects are going to affect the AI race. It's another monster created by the Trump administration. But let's talk about the bizarre trade deal that the US has agreed with Switzerland. Now, for this next image, don't laugh. It's very funny, but it's real, and I'll try to keep it very professional here. The US has reached a historic deal with Switzerland. Apparently, Swiss companies will invest at least $200 billion into the United States. At least $67 billion will come in 2026. The trade deal will also lock in US market access. This will benefit US manufacturers for at least $300 million. So this does sound impressive, doesn't it? On paper, Trump's shakedown has worked on the Swiss. Now the US plan is simple: get key Swiss industries to build factories on US soil. It's basically the same playbook done with Taiwan, Korea, and Japan. Identify which industries the country has a trade surplus with the US. Then you slap tariffs on them to unnerve their industries. And the grand solution is to uproot those factories to America. The trade representative Greer makes things crystal clear to understand.
Manage its trade surplus with the United States in terms of making sure that things where they have a surplus with us, pharmaceuticals, gold, etc. Their companies are going to build here, so it's going to eliminate some of the sources of that surplus. I mean, we've already seen Roche has actually broken ground already for a pharmaceutical facility in the United States. That's really exciting.
Sounds all good. Sounds like the Swiss are going to build gold refineries and pharmaceutical plants in the US. Now, well done, right? But it's so bizarre when you look at the official statements from the Swiss themselves. It reminds me of the deal with the Chinese. Besson expected Beijing to buy 25 million tons of soybeans a year. They also expected full access to Chinese rare earths, but nothing concrete was written on the Chinese side. Well, the same thing just happened with the Swiss. According to their readout, they signed a non-binding, let me repeat this again, non-binding Memorandum of Understanding or MOU. That isn't some firm contract written in stone, I'm just saying. Furthermore, implementing market access will not have a firm timeline. It'll be played by ear, so it's shaky at best. But here's the heart of the issue. Swiss companies are planning to make direct investments to the US. The amount will be $200 billion by the end of 2028. Now, firstly, it's a plan. Secondly, there's no exact specifics of the investments. Now, which companies and what type of funding is coming in? Doesn't say anything solid here. While Trump is busy signing weird deals, US consumers are suffering the consequences. And we have new data coming. The affordability crisis keeps getting worse. US grocery prices are exploding. The average cost of groceries for a family of four has gone above $1,000 a month. So Trump's stimulus will buy you 2 months of groceries at best. Compared to 2017, prices are up by over 37%. And on a year basis, this equates to over $3,300 more over the past 5 years. I don't know about you, but this is a crisis. We haven't even factored in other essential costs. We haven't even talked about rent or mortgage payments just yet. You throw in utilities and car payments, the squeeze is getting very real. And that's why we keep harping on the bifurcation of the US economy. In '08, it was Wall Street versus Main Street. Now it's the tech bros and data centers rising while consumers are collapsing. Now, can you rely on AI investments to prop up GDP numbers? Well, yes, you can, but can you do it forever? No, you can't. The US economy is still 70% driven by the consumer. 66% of US consumers are now living paycheck to paycheck, up from 60% just 2 years ago. This is truly frightening. Most of them are likely in the middle class. They are getting squeezed. Meanwhile, over 24% are struggling to pay their bills. The wealth divide is getting progressively worse. Sooner or later, this will come to a head. The BLS is going to give a jobs update in late November, but this report is for September's numbers. In October, there will still be a blackout, especially for unemployment. So we are in no man's land. Once the truth comes out, the markets and the entire economy could get a nasty shock. And this pressure could get unbearable once the numbers get released. Now I want to talk about the pivot point, where the cost of living or prices starts to collapse, but not for the right reasons. If consumers and companies reach the breaking point, we could have a big reversal. It's a deflationary shock that won't end well. Now the Federal Reserve just analyzed the history of US tariff policies, and the conclusion is quite jarring. The more severe the tariffs, it will eventually lead to lower inflation. Now, how can this be? Well, it's because consumption would collapse. Focus on the right side of the chart. That's US unemployment. The effective tariff rate today is over 17%. And the higher the tariffs go, unemployment rises higher and higher. A 15% increase in tariffs could spike unemployment by 3 to 6%. A year later, unemployment is still on average 3% higher. Maybe that's why everyone is worried about October and November's numbers, and something tells me the readings will be quite horrible. But when will those come out? In December or January 2026? By then, the Federal Reserve could have screwed up their rate cut schedule. We are in a very precarious position in Q4. Everything seems placid today. AI investments are booming, and it's good times for Silicon Valley. But big cracks are forming. It's getting harder and harder to simply ignore them. But let me know what you think. Was punishing Russian oil a good idea? And is there really an affordability crisis in the US today, or are we all hallucinating? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these inflationary times.